Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 285th VideoCast podcast for the week ending April 3rd, 2025. We got a lot of great stuff to cover this week. I'm sure you've all had a really fun day. Just kidding. But first, family first, then we'll get down to business. Want to reach out. Annabelle received an incredible shout out this week in Swim, which is a publication you might not know, but it's essentially the Wall Street Journal and the People magazine of swimming, of the swimming world, spotlighting the absolute best. So shout out to them. Shout out to Annabelle. It was founded by former Olympic gold medalist Mel Stewart alongside his wife Tiffany and their talented team. Swim has become the leading global source for all things swimming news and press, and that's why it's so thrilling for our amazing Annabelle to be recognized as the top 10 and under swimmer at the Southern California Swimming Championships and celebrated as one of the nation's top 10-year-olds this season. We are truly humbled by this honor. Really, congratulations to Annabelle, and really shout out to the folks over at Swim. You can check out their website, swimswam.com. Super good. Also want to shout out to Mimi and her team, who had a great weekend. Mimi had a big weekend, 3 goals in 3 goals we're going to share, 8 goals in 2 games. Here are a couple of my favorites. That's her on the breakaway. Pops it over. And then a couple more, and we'll get right down to it here. Here we go on a breakaway. Finds the open net. Boom. And finally here. Boom, pick in the corner. So that was pretty exciting. Now down to business. Had the pleasure to join Karina Mitchell. Also want to thank Bruno for having me on CGTN America. And that's Bruno Feldberg. And this was going into the announcement, which, came out kind of worse than most people expected in terms of the bite in the tariffs, and we're going to talk a lot about that today and how we can take advantage of the opportunity that it created. But let's listen in.
Off to a tense start to the second quarter of 2025, to put it mildly. Let's get some new insight into how markets and the economy are holding up amid all of the tariff tantrums. Thomas Hayes joins us for that. He's the founder, chairman, and managing member of Great Hill Capital. Thomas, thanks for coming on.
Thanks for having me, Karina.
So, Thomas, tell me, first of all, what do you make of market reaction today ahead of these tariffs? What's it signaling to you about just how much investors actually believe Trump follows through on all of these grandiose tariff pledges? Reports are 20% on a broad range of imports, but nothing's firm yet.
Well, this might be the most telegraphed, quote unquote, surprise in the history of stock markets. I think a lot of the bad news is already priced in. And as Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. And right now, people are super fearful. As a matter of fact, if you look at the AAII bearish sentiment indicator of retail investors, it's the most pessimistic since the tech wreck in 2022, and more pessimistic than the lows of COVID and the lows of the great financial crisis. So if you're not looking for opportunities in times like these with high quality businesses when they're marked down, when are you going to look for them? We say on Wall Street, it's the only market you can go when they hold a clearance sale, no one shows up to buy.
Yeah. So you say, buy the dip, look for the bargains now, stay ahead of the curve. If he actually does follow through, could you tell me, if so, if these tariffs stick for any period of time, what does that do to stocks and to the economy?
Well, look, it's a one-time level up, okay? And right now, based on how the market performed in the first quarter, with the U.S. underperforming international stocks by the widest margin in over 2 decades, S&P down about 5%, international up about 8%. A lot of the worst case is priced in. So you have a level up in prices. But at the end of the day, how many of these businesses are going to stand up factories in the US for 3.5 years and spend tens of billions of dollars to do so? The products that they provide will still be in demand. They'll have to get it. They'll have, some will get passed through to consumers. Some will be shared by the manufacturers and the suppliers. But at the end of the day, it's a one-time. It's not 20% compounded at 10% per year. It's 20% one time, and the market will digest it in a matter of weeks. And you can use that opportunity and that volatility to buy high quality companies for the long term. It's not the case that tariffs come in and every business goes out of business because someone new starts up in the United States. That's not what's going to happen. What's going to happen is there'll be some short-term friction and long-term reward. Welcome to Trump 2.0, same as Trump 1.0. New day, new headline, new volatility, resolves higher over time.
So you're saying everybody should just take a breath, but GDP for the first quarter is not going to come in anywhere near the 2.4% we saw in Q4. Some say we can actually see a contraction because of all of this tariff volatility. Do you think we need to worry about a recession?
No, I don't think we do need to worry about a recession at this point. The numbers that you're seeing as far as Atlanta GDP now are noisy because of inventories and some pull forwards and related to the uncertainty of policy. But this happens every 4 years. You have uncertainty in the first quarter with a new administration. It doesn't have to be good policy. It has to be known policy. And what the market grappled with in the first quarter was unknown policy, and we're going to get greater resolution. And you could find in the next few days or the next couple of weeks, this is a clearing event. Whether it turns out positive or negative, at least we'll know what the rules of the game are, and we can adjust accordingly. And that's what Wall Street wants to see.
So you're saying, it's been a miserable first quarter by all accounts, all the major averages lower, flirting or in correction, inflation creeping higher. So what do you actually anticipate seeing with stocks near term and then midterm as well?
Well, look, I think the theme that we came into the year with is going to continue. And the theme that we came in was you want to be buying international stocks, particularly China tech. Our largest position that we've built up over the last year and a half has been Alibaba. We think that's going to continue to outperform. We think international stocks are going to continue to outperform as the dollar weakens. Mag 7 would underperform due to increased capex and lower earnings power, decelerating earnings. I think we're at the point now where enough of those stocks are oversold that you could see a bounce in Mag 7 in the coming quarter. But I do think it's going to stay in that range, even if it trades back up to the top of the range. I do think Mag 7 will underperform. I do think international stocks will outperform domestic stocks this year, and that's where your opportunity is going to be. So if you're a trader, maybe take a punt on some of these tech stocks. If you're an investor, start buying industrials, everything that's perceived to be affected by tariffs that has been marked down. This is a perfect example, Karina. Instead of buy the rumor, sell the news, this is a sell the rumor, buy the news. Sell the rumor of tariffs, buy it when it's actually announced. And I think we're going to have opportunities here into Q2 and beyond. Guidance has been taken down materially in Q1. That's the normal game every year. First quarter, CEOs give conservative guidance so they can beat in the subsequent 3 quarters, get their bonuses, get their options. Shareholders are happy, and this year will be no different.
I love that you're talking about international stocks there as well, because Nvidia down 21% year to date, Tesla down 28% year to date. Tell me quickly, where do you stand on gold? Where do you see that going?
I have no view on gold as it yields no cash. I like businesses that generate free cash flow that I can measure, that are growing, that are high quality, durable businesses. Gold is just a bet on who's going to come in after you and buy it at a higher price. And that I'll leave that game for other people.
Okay, we'll see how it all shakes out on Liberation Day. Thomas Hayes, thanks so much for coming on.
Thank you, Karina.
And still
in here. And we're back. And then, and by the way, not much of that changes, even though the facts somewhat changed. And we're going to go through why. So first and foremost, this just came in after the close today. Trump tariff live updates. President Trump says he's open to negotiations, contradicting White House aides. like Peter Navarro and others. And so that's that. The other thing I wanted to do is step back and put things in perspective here. I just kind of said $600 billion. Okay, so let's say this is the number. What's the number? So what is everyone afraid of? Well, the stock market is comprised, the name of the game with the stock market is called earnings, okay? And so I pulled this up and I found out what is the aggregate net income, meaning the earnings power of the S&P 500 over the last 12 months. And it came out to 1.9 trillion, okay? 1.9 trillion on, I think it's about 19 trillion, $17 trillion of revenue and 1.9 trillion of net income. So you could say, okay, we have a problem. Houston, we have a problem. Number one is if the S&P 500 companies, number one, they're not 100% of the companies in America. So let's just assume they're half. So that means it would be a $300 billion if they assumed all of the loss. They passed nothing on to suppliers. They passed nothing on to customers. And they just said, well, we're going to be a benevolent company. We're going to actually switch the opposite of ChatGPT. We're going to go from being a for-profit to a non-profit. And we'll just eat all of these tariffs rather than pass it on to consumers. You're basically looking at, 300 billion of 2 trillion. So, you start to get into 15% of earnings, give or take. That's if they assume all of the pain, all of the time, 15% of earnings. Well, last I checked, the S&P 500, I believe, is down, give or take, 12%. Is that correct? Maybe more today? Let's pull it up. Okay, so you're effectively at the worst case scenario, meaning the market's down 15% and earnings are down 15%. Okay, so year to date, okay, so it was 3.39 yesterday and it dropped 5% today. So you got, give or take 9. It dropped a total of 10 or 11%, was in kind of correction territory this morning. So give or take 10%, 11%, and you've got 15% of earnings. Now, number one, I've probably overestimated the percentage of the 600 billion that's attributed to public companies versus private companies. And number two, I've 100% overestimated the amount that the companies are actually going to eat. This is effectively, there's no other way to say it. This is a tax on the poor, okay? Now, ultimately, in the short term, because it's not, whatever it is, 20+% compounded at 10% a year, it's a one-time level up. So it's a one-time tax on the poor. Why do I say tax on the poor? Because the average, a lot of people don't feel $1 in milk or, $1 per gallon in gas, and a lot of people do. But the people who do are the people who are going to feel it the most. So this is going to hurt them the most in the short term. In the longer term, I do think this is going to be much better for labor than it is for capital, meaning the people doing real jobs are going to be proportionately gaining a lot more than the people managing assets. And that's a good thing. And that's what we saw in the first term of Trump 1.0. Real wages at the salaried level increased by the most for across all demographics, but particularly the low end and the middle end got the biggest bump. Minorities got the biggest bump. And I think that's a great thing for America. And I think that's going to be the result that happens out of this. So, but since we're on a stock market podcast and we want to make money in the stock market, what we have to do is out of every crisis comes opportunity, and take advantage of these opportunities when they are handed to us. So couple quick shout outs before we start to drill down. I just wanted to really kick off by showing you zoom out, and effectively you're looking at 15% maximum absorbed by the hit to EPS, and then more likely than not, it's half of that, which is 7%, which the market has already priced in. And that's why I love these undercuts. So we went back and retested the lows, and you always have to undercut to really scare the pants off people and give them their stock. I had the anyway, it's funny. The people who don't give you business are the first ones to call you and ask you for your advice when these situations happen, and it's kind of comical, but nonetheless, I'm always happy to help. And I said, look, actually, their question was about VF Corp, and what I said was, listen, I can guarantee you 100%. If you're going to sell your VF Corp today, there will be a buyer, okay? I just need you to text me 20 seconds before you place the sell order, okay? I'm happy to take every single share that you have in your possession. And we were in the market buying. And I want to acknowledge too, just, first you build something, then it builds you. And I think that's really what's happened with this podcast. I want to acknowledge one person in particular. Was the first email I saw this morning when I woke up and I saw the futures down, S&P or Dow was down like 1,200 points. Marlon, I'm not going to give your last name, but Marlon is a larger, longtime customer. And he said to me, Tom, use my margin to buy stocks today. I'm sending you another 7 figures tomorrow to cover it. And then he quoted my quote, which is Warren's quote, when it rains gold, put out a bucket, not a thimble. And I was in the market taking advantage of that for Marlin. And I was in the market across every single account where I could find some space to take advantage of these opportunities. Does that mean that I'm like Peter Navarro, who got on at 4:30 and said, based on my technical analysis, I think this is the bottom of the market? I mean, what a complete asshole, to be honest with you, to get on TV and say that after putting out this policy. But leaving that aside, it is what it is. And you literally can't make this stuff up. But so we were able to do that, and in every account. But we didn't go cowboy. It's not like we're going to exceed our position side limits. It's not like we're going to exceed our maximum leverage that we're willing to use, because at the end of the day, these things are already priced for death. So they overshot for a day, maybe they'll overshoot for a week until April 9th when everything's finalized. But I think more likely than not, all the weak hands are out, and you basically have opportunity prospectively moving forward. So that's what we wanted to take advantage of. And going back to the seasonal stuff that we've shared with you over and over, it tends to get weak in the post-election years up until the end of March to early April. And we've been talking about that for some time, ever since we said, buckle up, Buttercup, February and March get bumpy, make your shopping list. Intel was one of the stocks we were in buying today as well, not just VF Corp, but Intel. And Intel announced that, or the information had leak out, Intel TSMC tentatively agreed to form chip-making joint venture. Were we able to get it at $19 and $18 like we could last fall? No, but did we get it at high 20 and change, just below 21 today? Yeah, and that's a gift. That's manna from heaven. I mean, Lip Tan just bought $25 million with his own money at $25 a share, and we were able to top up at less than 21. That is manna from heaven. Also want to shout out to not only Marlon, I want to shout out to my clients. Large family office came in from Dallas. Chris and Brian for having me up to LA, took me out to a great breakfast. We got to catch up and hear about all the exciting stuff that they're doing. So super excited for them. I also had the chance to speak to the YPO Dubai today, thanks to Craig and to AJ for setting that up and making the introduction. We'll be seeing you briefly in Dubai when I'm out to see a great client of mine in Dubai. I'm super excited for that in the end of May. And that's that. So just going through methodically everything we want to cover. Now, let's look at some indicators to kind of see where we are and see if Peter Navarro's technical analysis is going to save the day. Unless he knows a ton of liquidity is coming and he wants to look like a genius, which I wouldn't put which I would not put by him for sure. This is not updated for today, but my guess is this is well above 1.0. Everyone likes to buy puts in the hole. Same thing with the TRIN. We kind of peaked out a couple of days ago. Option skew is looking okay. Bullish percent S&P 500 is getting towards the bottom end of the ranges. 10-day put call is elevated. PMO buy all and buy SPX have held up a lot better than expected, given that the market is down, which tells me that less stocks are going down than you would think based on the indices. And oddly enough, the ones that have been most impacted, and even today, if you look at today, before I switch out of this, it's been Mag 7. I mean, Mag 7 has been getting pummeled. And we got out of it all at July, and we thought we were geniuses, except it went up another 10%. And now it's well below where we got out in July. So we're never going to get the perfect top. We're never going to get the perfect bottom, but we get enough of the fat in the middle that we are happy. So bonds are outperforming the S&P. National Association of Active all the active managers have sold down in the hole now. They started selling when we hit the first bottom, and that they've sold everything out, which means we're ready to go out. We're ready to turn the corner, and it's not going to take a whole lot because basically the worst case scenario news is out. On a daily basis, I mean, are people going to want to be long into the weekend? Maybe, maybe not. We'll see. But when you see the NYUD down negative 6,000, I mean, we haven't seen that in ages. I mean, that is usually where you're going to see a massive, let me just see here. On a daily basis, you're going to see a massive bounce. I mean, this is hysterical. Daily. So you saw it in December of last year. You saw it in August. Let's see if we can get an overlay of a price. I don't know if we're going to be able to see it daily, but I can just tell you that this is extreme. And let me put it behind there. So yeah, that was the short-term bottom. You got a huge rally off that. That was a short-term bottom. You got a huge rally off that. So you definitely, I mean, this is capitulation. Okay, this is definitely short-term capitulation. Certainly for the next couple of days, I would think, and I'd be close to betting that it's near the bottom. So for those of you who already got money in, you're golden, your position. For those of you who are trying to get into this second quarter raise, get it in now, because like 2 weeks from now, look, it could be lower and you're a genius. In 12 months, it's not going to matter. It's not going to matter whether you bought VF Corp at $16 or you bought VF Corp at $12, because 12 to 24 months out, it's going to be back at mid-20s and probably the 30s, and then the business will start improving. Same thing with Cooper Standard. Baba's held up. It was actually green part of the day. Intel was green part of the day. Crown Castle's been doing great. So, you know, these are the opportunities. And I put out on Twitter, gosh, I didn't have any of this stuff queued up, but let's see what we can do here. first thing this morning when everyone was puking at the open, I put this out. And what I said was, and this is something that you may want to print out. I said, private equity funds will take no markdowns today, quote unquote markdowns today. Apartment owners will not fire sale their buildings today. It's why efficient market theory doesn't work. If it did work, I would be out of a job. Human nature never changes, and that's why I've been able to do what I have. And that is never going to change, ladies and gentlemen. And it's during these periods of dislocation. I mean, this is really the only place you can get outperformance is if you're buying over the last 3-4 weeks after you put in the first bottom in early March, and then you continue to add on the retest and now the follow through and the fake out and all that stuff. If you're not buying when prices are crazy town and you have forced sellers and margin clerks calling people up and forcing them out of the market, you're just not going to outperform. What today is the closet indexers that have been jammed into Mag 7, all caught with their pants down, swimming naked. And that's really what it comes down to. Why are the biggest losers of the year Mag 7 when most of them are largely unaffected by tariffs? And the answer is because they're all sheep and they all got slaughtered. Okay? Let's look at year to date. Look, the whole market is green. And if you think the whole US market is green, how about the Chinese market? Okay? Look at the biggest losers of the year. Mag 7. Microsoft, Apple, Amazon, Tesla, Google, Meta, Nvidia, okay? Again, go back to the June 20th article I wrote, the next pain trade when Nvidia was $140 and it went to $152 after I wrote the article and everyone said you're wrong. And today it closed at $101. Okay? So this is all you need to know, ladies and gentlemen. If you are here because you have a fake manager that was closet indexing like a sheep and got slaughtered and the market's down 5% and you're down 40%, well, that's all you need to know. But if you have an actual manager who's got you in good quality stocks, you are going to be great moving out, okay? And here's the better news is all these closet indexers got forced liquidated in the last few weeks. So when these technically bounce, and these are going to bounce, by the way, they're not even going to be in it. So they're going to miss it on the downside, selling in the hole, and they're going to miss it back on the upside, and then they're going to buy back at the top of the range. And as Mag 7 underperforms this year and goes back down after it gets to the top of the range, they're going to get jammed again. And this is just history repeating over and over and over. So as you can tell, I'm kind of going ad lib today because we're, live in real time taking advantage of all this stuff. And this is going to be a long one. So, if you don't want information to make money during crisis, then go watch Netflix. But maybe it'd help their stock a little bit. What did Netflix do today? I don't know. Can't even find it. But if it's Mag 7, it's probably down this year. So leave it at that. We went through these indicators. We went through this. This is unbelievable. This NYUD. Skew, when skew gets down to this level, you're pretty much bottomed because all the insurance plans, out of the money insurance plans, have cashed in or not. Values continue to outperform growth. This might be a short-term peak. Maybe the tech starts to bounce and brings the indices up. But let's look on a company-by-company basis. I mean, this feels like the apocalypse for a lot of people that have been stuck with closet indexing or actual indexing, and you've just been passive and you finally got your head handed to you. But like Boeing, I mean, I love it here. Does it go lower? Sure, it could go lower. It could go back to 138. But I mean, if you're not starting to buy it here and you don't see 2-3 years out, this thing's a double, then I can't help you. Wrong podcast. Go for the Shiny Object podcast that all got you slammed into these. And now you don't know which way's up because you were levered long all this garbage that has gotten smashed. Moving along, let's take a look stock by stock. Disney. We were in the market buying Disney today. I mean, we haven't had a chance to buy that in ages. Nike, I got to tell you, I mean, where did Ackman get in? $78. Now it's at $55. My guess is he was in the market buying today. I can't speak for him, but we like Brack and Darrell much better. So that's kind of where our focus has been. But I think you can't really go wrong in the low 50s, high 40s with that. Disney, Caterpillar's had a big run. I mean, even Microsoft, this looks like it wants to bounce technically. JP Morgan, these are not catastrophic moves. These are really a lot of different opportunities. Let's look at some NASDAQ stocks. Biogen has been cheap forever. Keeping my eye on that with biotech. That's gonna. We were in the market buying XBI. What else? NVIDIA, new low. This is probably the fake out to take out the final. Anyway, Meta getting smashed down from 725 to 525. I mean, look, I got to be honest, some of these are getting tempted, but if I have my choice to buy Meta or to buy PayPal, we were buying the hell out of PayPal today. I mean, this is, the EU's threatening, we're going to charge a tariff your payment people. It hurts their own people. If they do it, they do it. If they don't, they don't. The bottom line is the guy's going to buy back 20% of the company over the next 24 months. It's a leading business. If they get hurt, their competitors are going to get hurt more. At the end of the day, it's what I tried to share with you last week, which is if it hurts these companies that have a moat, it hurts their competitors even more, which means they're going to be able to consolidate them and buy them up and come out stronger. So bigger companies, quality companies, and that's what I do in periods of dislocation. I'm not buying the lowest quality stuff that could actually get toasted. I'm buying some of the highest quality in their spaces. So during these periods of dislocation, they're actually the gainers. They consolidate the weak people, like Baba when China was uninvestable, like ExxonMobil during 2020 when oil went negative, like Wells Fargo during the COVID lows at 25.10, highest quality in the periods of mass dislocation when banks and energy were getting hammered. Last 2 years when China was getting hammered. Now you got sneaker companies getting hammered and everything else. So this is like, a day like this, look, everyone gets hit by a mark to market and people think that matters, but these days are like Christmas. I mean, people could not understand. I was talking to the YPO group and they couldn't understand why I was giddy. I was like, listen, I need to get off this call because 11:30 is coming up and the losers in Europe sell at 11:30 because they're chicken littles to go home long. And then I need to be around for 2:30 when the margin clerks hit up the US guys that are levered long on their zero dated options. So when they're structurally blown up their account, I can buy all the shit that they're forced to puke by the margin clerks. And that just comes from experience, and that just comes from knowing what you own and owning quality businesses. So if the marks went another 10% lower, would I be excited about that? No, I wouldn't be excited about that. But would I be worried about that? I would not be worried about that, because if I look 12, 24, 36 months out based on the businesses that we own, and we've underwritten as if we own the entire company before we even buy one share of stock, we are not chasing price. We are not doing magical technical analysis like Peter Navarro calling the bottom today because he used to be a CNBC contributor and he's an expert technical analyst commentator that's now working $100,000 job after getting out of jail. So I'll tell you how I really feel on the next podcast, but leave it there. Magnificent Seven relinquishes more than $1 trillion as tech drives stock market nosedive. So look, we spent 3 months saying lighten up on Mag 7. Canadian dollar climbs to 4-month high after tariff reveal. Ladies, it's finally happened. Did the Canadian dollar go against us before it went for us? Yes, but it's now moving up, and I think it's going to persist. So all the Canadians that are worried and angry at Trump, don't worry. You're going to be fine, okay? All the Mexicans, you're going to be fine. Don't worry about it. It's going to work itself out. I'd be long the loony. You guys are going to have huge purchasing power over the next 12 to 24 months. The tariff thing will get resolved. You have natural resources. You're a great country. You're a great ally. You got great leaders like Wayne Gretzky. I'm joking, not joking. And you don't need to become a state to be amazing. You're already amazing. We love you. I know we have a lot of Canadian listeners. All right, let's get down to business here. We've got number one thing you want to look at during periods of crisis is high yield credit spreads and a quick proxy for that is just take a quick look at JNK. Credit markets are not seizing up despite fear being at record all-time highs, worse than during the great financial crisis lows and the COVID lows, if AAII bearish sentiment is of any importance to you. We're effectively back to the levels we were in high yield at the beginning of the year. So not much to worry about. If it shoots down here, we start to get a little bit more concerned and maybe adjust accordingly. But at the moment, all good in the hood. Next is S&P 500. I love the undercut. You often see tests, then overshoots and undercuts during major bottoms. Here we are. Could it go a lot lower? Sure, it could go a lot lower. Would I bet on it? I think it's going to work itself out in the next week or so, if not sooner. And I love this undercut because it forced all the remaining hands to capitulate. We could go back 20 years and everyone says, we're going to go back and retest the lows. You never really go back and retest the lows. You tend to break down to get everyone out and then you open up higher after doing that, whether it's on a weekly or monthly. Well, guess what? Our TLT. Speaking of which, a friend texted me today and said that one of his clients just got a 7-year adjustable ARM mortgage at 5.1%, 7% ARM at 5.1%, and that is a first-time home buyer. 5.1% mortgage for the next 7 years for a first-time home buyer. So housing is going to be the name of the game. And when 10-year yield got to 480, everyone was saying 5, we were saying 3 handle before 4. Well, here we are at 4. We're going to hit a 3 handle, and we're going to start to see high 5s on the 30-year mortgage, and housing is going to rip, which was our article of the week, Home Sweet Home, which we're going to cover. Dollar. How excited are we? The dollar is collapsing. Is it? It's just getting started, ladies and gentlemen. This is going to go a lot lower. So all you folks with the loonies out there, rock and roll, baby, save your cash. You're going to have some serious purchasing power around the world. This is the beginning, just like we saw in 2001. This is going to continue to downtrend the US dollar. And like we talked about last week, this may be a precursor, part of the negotiation with the tariffs. Hit them in the forehead and then say, okay, well, if you don't like tariffs, let's both go to 0 and you're going to stop manipulating your currency and we're going to revalue the US dollar like we did in the Plaza Accord in the 80s under Reagan. We're going to do the exact same thing and we'll take down the tariffs and boom, we're off to the races. So all of these things are on the table. And if you're not positioned, and I'm not saying, levered long S&P, but buy a handful of great businesses that you love that are already pricing in the apocalypse and just sit tight and don't do it on any major leverage or any major margin, modest so that you can sit through any fluctuations of the next few weeks and not get shaken out like so many people today. And you're going to thank me later. And it's rinse and repeat over and over. And if days like today didn't exist, there's no way any manager can get significant outperformance if you're not in a position to be able to buy during times like the last few weeks where they served up unbelievable businesses at generationally advantageous prices, and we took advantage and we pounced every red day, and today was another day that we're taking advantage of. So that's a put call. Not all of these are up to date, but look, you start to see levels of extremes that become buying opportunities for the people that are informed and paying attention. Major buying opportunities. NASDAQ up, down. I think NASDAQ gets a bounce here. I think the Mag 7 is going to get a bounce. I think it trades to the top of the range in coming months, and then everyone jumps in at the top and it goes back down. Mag 7 underperforms this year. China outperforms. Been saying the same thing. Next few months may look a little different, but when we get to December, that will be the outcome in our view. Small caps we're buying today. I mean, you got to skate to where the puck's going, not where it's already been. National Association puked in the hole. Could they puke more? Of course they could. They might be forced to puke a lot of the closet indexer that were all Mag 7. They're just getting roasted. All the FAs that have all these index funds, I mean, their clients are calling them all day long. They don't know what they own. They're just like, it's going down. What should we do? I don't know. What do you want to do? What do you want to do? What do you want to do? I don't know. What should I do? Boss, what should I do? Because they're asset gatherers. It's a whole different game. S&P 500 bullish percent. Okay, this is a level, again, where you start to find bottoms. Okay, same thing, by the way, at the beginning of March. Okay, and that's it. You're retesting. Now you broke through. Could you cascade waterfall all the way down and it's 1930, Holly Smooth, and the world is ending? Yeah, it depends which depends which TV station you tune into. If you're tuning into MSNBC, we're in a Great Depression and, buy gold and guns. If you know what you own and you understand what's going on, you're probably saying, where can I take advantage of this opportunity? McClellan Summation Index, NASDAQ, again, towards levels where you buy, you make money. Same with the NYSE Summation Index, same story, the retest, boom, boom. So these are levels, again, it pays to be a selective buyer versus a seller. Okay. VIX popped up over 30. Could it go to 38 before it goes back down to 15? Sure, it could. Would I bet on it? I don't know. I'm really not worried about that. I'm not worried about owning Boeing at $140 or $150. They're in a duopoly. So if you can tell me people aren't going to fly because of tariffs, then I'll listen. But they've got $500 billion of backlog. What if it goes to 400 billion? Am I going to lose sleep? No. Okay, I'm going to take advantage and seize these opportunities. Okay, moving along. Most of the quotes of the day. Most of the time, common stocks are subject to irrational and excessive price fluctuations in both directions as the consequence of the ingrained tendency of most people to speculate or gamble, not knowing what they own, chasing price versus value, to give way to hope, fear, and greed. That's from Benjamin Graham, Warren Buffett's teacher, and the legend. John D. Rockefeller, the way to make money is to buy when blood is running in the streets. There was blood running in the streets. There were forced liquidations today. You had some people calling their financial advisors and all their index funds saying, get me out at any price. I voted for Kamala. And then you had other people like Marlin who first email in the morning, and there were others, by the way, which I'm very grateful for, saying, buy everything you can on margin. I'll send you 7 figures tomorrow to take the margin down. And there you go, and he's going to, 12 months out, it's probably going to be one of the top performing accounts of all of them because he took advantage of today. So the market does not beat them. They beat themselves because though they have brains, they cannot sit tight. That's Jesse Livermore. Moving along. In pod chart. So Lip Bhutan addressed the Intel Vision 2025 yesterday, and he outlined his top priorities: focus on engineering talent, particularly tied to DCAI, execute on Panther Lake and iteratively improve yields, improve foundry, more details to come, expand product portfolio into verticals, lean on purpose-built silicon as a secular theme, desktop software to support AI application layer. That is critically important because that is what everyone said was NVIDIA's moat, was they had the software kind of like the Apple walled garden. This guy is the master of it. Cadence Designs was the software that all chip designers used to develop when he built out that company. So now he's going to do it proprietary inside of Intel, coupled with the foundry business. This is going to be a legendary turnaround story in my view. Okay. This is from our friends over at Stifel, looking at country by country for each company. So Vietnam got super high tariffs. VF Corp has exposure there. 26% of their exposure is Vietnam. So only 15 in China. I would have thought it's a lot more than that. I would have thought they were like 80% China. So that's kind of good news. But could they move this 26% to Bangladesh where the tariffs are lower? Sure, why not? Give the Bangladeshis some business. Move on. March didn't pan out, but April is historically one of the best months. That's from Ryan Dietrich. So let's see what happens here. That would be consistent with everything we've been talking about. If you remember, on March 11th, I was on Varney & Co., which I'm going to be, no, that's the following week. Never mind. I might be tomorrow morning, but everything is in flux. More likely than not, I won't be. And I said they should come up with a website and just show item by item how much do they tax us and how much do we tax them. And that's exactly what they did. It sounds like Trump and some of his advisors watch Varney on Fox Business, because they laid it out pretty clearly. Okay, what do they tariff us? What are we going to tariff them back? And in most, if not all cases, other than the low end at 10%, we came back with about 50% of what they do to us. So it's not reciprocal. It's not that, but it's in a direction that's going to generate 600 billion plus, which is get ready for the next phase. So he said today in a tweet, he said the operation is over. Now the patient can heal. Depending what TV stations you watch, you said, no, yeah, the operation's over and they're carrying the patient out in a body bag. Well, that was the case for some people today. But more likely than not, the patients are going to start to heal. And the new narrative prospectively will be, one, probably a couple of deals will be done, even though Mr. Technical Analysis himself, Mr. Navarro, said that wouldn't be the case. 2 minutes later, Trump said it would. The next phase is going to be, we've paid for the tax cuts, and they're going to do one of the largest tax cuts again, extending the existing and adding some more tax cuts. You couple that with deregulation. Now you've got growth. It's paid for. And that's that. Where they are now going to probably be willing to cut a few deals is because they do not want to wind up in recession, because if they wind up in recession, on average, it takes 2% of GDP to bail them out of recession. So the last thing you want to do if you're trying to cut all these deficits and cut spending is force the country into a recession, where you have to spend, $400 or $500 billion to get us out of a recession. So they're cognizant of that. My guess they'll cut just enough deals to get the market excited. Trump said as much today. He wants to see the stock market do really, really, really well. He has a strange way of showing it. But get ready for growth narrative. Growth narrative being tax cuts, deregulation, and tariffs in the rearview mirror, because that's largely done. Here's a chart to pay attention to. This is the tariffs done to date. I don't know if this is accurate, but basically if 100% of these are implemented and there are no concessions, it takes it back up to 1909 levels, which is basically where it was for 100 plus years before the turn of the 20th century. I don't think that this is where we're going to wind up, but it's something to watch, and it's something that all the people that are extremely concerned have in their quiver, and it's not something that we're blind to. So we'll see where this thing shakes out. Hard and soft data have diverged. So this is what's actually happening versus, so Conference Board expecting fewer jobs. A lot of people are nervous. The initial jobless claims are not yet confirming that. We will see tomorrow. What I will say is critically interesting, which we're going to get to, is Fed is now at 85% chance of a cut in June. Here are my incredible mugs. By the way, all of you are asking for merch. Thanks to Stephen F., who does all the videos on TikTok, Twitter, and everywhere you've LinkedIn, X, all the different threads. We're going to start having merch. It's going to say hedge fund tips. We're going to have golf shirts. We're going to have hats. We're going to have all that stuff. For those of you who like that stuff, we're going to have it. Jay Capel, still another sigh. Gentle reminder, the nature of investor sentiment. Bad is ultimately good. Consumers are certain unemployment is headed higher. Could they be right this time? Sure. Will they be? Decide for yourself. So every time they got this nervous, which one of those times was 2001, which we continue to reference as a very interesting parallel for a lot of the stuff that we're doing, it was a buying opportunity of the century. 2009, did you want to buy stocks? Yes. 2002, did you want to buy stocks? Yes. Early 90s recession, did you want to buy stocks? Yes. Okay, so that is an opportunity. Just kind of year-to-date returns. The last shall be first. Healthcare is up at the top. International's up at the top. Energy's outperformed. Comstock's been on a tear, so we're super happy about that. Gold is outperformed, so all the end of the worlders are super happy. Congratulations. Just, not what we do, but, kudos to those people who do that. Equities, aggregate institutional net flows. Long onlys have been puking in the hole. Hedge funds puking in the hole. Opinion follows trend. So they were all buying at the top, selling in the hole. So, you got to decide what you want to do on that. Prime book, record lows, just like. So that's that. ECB survey, change in demand for loans. That's going up, not down. Auto tariffs could reignite used car prices and auto repair business. That's where advanced auto parts starts to flourish again. Retail purchases of Mag 7 bought the top as always. UK retail sales continue to recover, which is good for GXO. US equity sentiment indicator washed at very low. Wall Street currency watchers see dollar losses ahead. So now opinions following trend. But as we saw in the long-term chart, I think this trend is just beginning. Weaker and weaker dollar benefits international. We've been pounding the table, and what you've seen in the beginning of this year probably breathe for a little bit, but it's just the beginning of a multi-year international versus US outperformance. Kind of ironic that US equity exceptionalism will have peaked with the advent of the new administration. And I don't think that speaks poorly of the new administration at all. Part of it's just the person sitting in the seat. Like I said, I think the economy is going to do better than ever. And I think the middle class and the people who haven't participated in asset price appreciation are going to do better than ever. I think passive indexers are going to be less happy. I think stock pickers are going to have the time of their lives. Like the early 2000s, like the 70s when Gabelli and Cooperman and Buffett made their fortunes. Market went sideways for 12 years, and so generally very, very constructive. And it's not to speak to the policies, because I really do think you're going to get that excitement you saw in the first term from an economic standpoint, with every man on the street super happy, having jobs, having higher pay. But making money in the markets, you're going to have an advantage. You're going to have some international. You're going to have to know what you own. And I think the way the non-Mag 7 stocks are set up, and other opportunities, and even small caps coming back, it's going to be lights out the next 5 years. I mean, lights out in a good way for opportunity. And then the window will close and it'll be done. So prime book, Infotech versus total US exposure. So again, this is getting washed out here. I do think tech probably starts to bounce. Value versus growth. Value's been outperforming. 23% of stocks beat growth benchmark, beating Russell 1000 growth index based on trailing 12 months. So this is kind of what you see when you want to be a buyer. Magnificent 7 to Lagnificent 7. Magnificent 7 market cap as a percentage of S&P has now dropped from 35% down to 30%. Boy, that was quick. Wow, that is unbelievable how quickly and it's probably going to trend even further down, even if we get a technical bounce. Stocks at record 29% of U.S. household financial assets, buying the top. No international exposure, common theme. That's going to change very quickly, and a lot of that money is going to flow into international. Next, slowdown coming in global semiconductor sales. We talked about NVIDIA in June, saying this is a cyclical business. I think the one play that's going to be doing well while the rest are suffering is going to be Intel. Why? Because every other chip maker depends on the kindness of strangers with Taiwan Semiconductor. Intel is going to be a producer of chips, not just a designer of chips. And they're going to start to take share from Taiwan Semiconductor because Trump's going to make sure of it, whether he likes Intel or not, which I think he will. I think he's going to love Lip Bu Tan. And as he would say, because Lip Bhutan is a winner and Trump loves winners. So expect good things from Intel, even if this cycle slows down. They're going to be taking share from monopolistic producer Taiwan Semiconductor, or partnering with them, as we saw in the information, which is even better. American stock, it'll just accelerate the process. American stock's worst quarter in 23 years relative to international. That's been our theme. Get out of Mag 7, get international. It all showed up at once in the first quarter, and that's super exciting. U.S. fundamental long short net leverage. So they've just absolutely gotten smoked, gotten out of all leverage. That's why Mag 7 is smoked. They're just liquidating out, getting redeemed out, and bleeding on the carpet. And that usually creates the vacuum for smart buyers to step in. Here is the 5-week moving average of the AAII bearish sentiment index. It is worse than during the COVID lows, worse than during the great financial crisis lows, the worst going all the way back to the 2022 lows, and then prior to that going back to the 1989-1990 recession lows. They're as bearish as they can get. So you can tell me that I don't want to be a buyer when everyone else is bearish, and I say, okay, well, you're part of the herd, but you don't get these type of returns by buying when no one wants to, in the hole when everyone else is pessimistic. A bad March can mean a better April. So this is from Carson. When you have these horrible Marches, April is on average up anywhere from 1% to 13%, with an average of 2.9% and a median of 2%. So if you think about the indices rallying 3%, you start to think about individual names rallying 15, 20, 30%. And for folks like Marlin, who woke up this morning and saw opportunity and put out his bucket, kudos to you. 12 months. I can't tell you where Marlin's going to be 12 days from now or even 12 weeks from now, but I can tell you 12 months from now, he's going to look back at that email and realize what a rock star he was. And for the new people that have been coming in today, the new inquiries to get in before we close out this Q2 opening, we're going to close out on the 12th, so 9 days left. They'll have the same exact thing. And the existing clients, we've been topping up. You guys are so well positioned. Look, I can't get brand new people in the spreads on BABA that we did a year and a half ago that are up huge, millions of dollars in aggregate, but that's the way it goes, but I can get them in other incredible opportunities. Just like, if you're fully invested, I can't get you, in, a ton of VF Corp at $13, but you already have it at $15. So, or $16. So it's just opportunities galore. So let's look at price to earnings here. Nasdaq's valuation retreat. So it's gone from 37 times earnings down to 22 times. So if you remember, I spent 5 weeks going on TV in December and January saying Mag 7 earning PEs 33, 35 times. Their earnings growth decelerating from 33% down to 16%. The multiple hasn't come down. Well, guess what just happened? The multiple came down. Probably comes down a little bit more, and then you get your huge technical bounces. Moving along. All country world performance. So obviously outperformance of international, re-emphasized there. Consensus earnings growth. The biggest consensus earnings growth expectations are small cap, and they have the lowest multiple, and you can't give them away. I was buying that today. So, okay, into other people selling. We went through this with Baba, ladies and gentlemen, and that's why we have a basis of $82, $83, because every red day we had an opportunity to sell in the hole, like 99% of the people who listen to the sell side telling you uninvestable, or the 1% who are backing up the truck in the 60s. And many of you have benefited from being part of the 1% who are backing up the truck in the 60s with your white knuckles and all. We all had a little bit of white knuckles, but we sucked it up and we knew what we owned. And we had $80 billion of cash on the balance sheet, trading at 10 times forward, starting a recovery. And it's just beginning. So same thing is going to happen here. S&P returns following a 10% correction, 12 months out, on average up 12% without a recession. I think we're not going to have a recession. Maybe we get 1 quarter of negative GDP, but I wouldn't hold my breath. Hard data versus soft data, so that's a bullish sign to keep it in mind. The real data versus the sentiment is still holding in just fine. US, okay. US versus non-US stocks have alternated outperformance. This I've been emphasizing for many months, 3-4 months. People say US exceptionalism is going to last forever. I don't care if Jesus Christ himself became president in November. The odds of US stock performance, which has pulled forward a lot of returns in recent years, continuing to outperform international, would be very unlikely. Okay. So as good or bad as you believe the policies are going to be for the next 4 years, it doesn't mean that US stocks have to outperform or underperform. It's just the nature of the cycle. Okay. So like 1964 to 1989, US was flat, international dramatically outperformed. 1989 to 2000, 2001, US dramatically outperformed, international didn't. Then you had 2001, 2002 to 2008, 2009, international small caps value outperformed. Then you've had the zero interest rate policy, once in a lifetime event from 2010 to 2022, US outperformed, and that's changing. Now you're seeing the stimulus coming from China, seeing the stimulus coming from Europe. That's where the money is going to flow, where there's liquidity, not austerity, cutting, thousands of jobs in Doge, which, look, has to be done, but there are consequences. If you're austere, you're going to detract capital flows. If you're accommodative and stimulative, you're going to attract capital flows. China was austere for 3 years, and then they flipped the switch when they had a bunch of 20% of 25-year-olds unemployed and starting social unrest. They flipped, and now Alibaba doubled, okay? And it's going to double again. So these things run in cycles. Here's auto sales for March. Blew the doors off beyond any possible expectations. So a little bit of pull forward, but you're starting to get the price cuts, which this may be slightly more sustainable than people actually think, even with the tariffs. Why? Because the OEMs are going to eat the prices and they're going to subsidize the losses because they don't want to lose share in this environment. And it finally got them out of their monopolistic, sell above MSRP, COVID, Lollapalooza that they experienced, that they thought they would be able to run forever, and the gig is up. Now it's going to be volumes, low prices, low margins, and suppliers, the arms dealers, are going to start to win again. ADP manufacturing jobs monthly increase. So the question from this is Trump's plan working? Manufacturing jobs are growing for the first time in 2 years. This doesn't say Wall Street jobs are growing. It says manufacturing jobs are growing. It doesn't say white collar jobs are growing. It says everyday jobs are growing. And that's a good thing for America. So we should be celebrating this, not on Twitter whining because your Mag 7 is 30% down because you couldn't read the writing on the wall. That was pretty obvious to everyone that was paying attention 3, 4, 5 months ago. Ward's Automotive U.S. auto sales SAR, through the roof. We haven't seen a level this high since going back to 2017. So let's see if we can maintain it up here, because if we can, the amount of money that Cooper is going to be spewing out over the next 12 to 24 months is going to be staggering. Tariffs or no tariffs, the volumes are going to be through the roof. Share repurchases. What else do we have here? Rare moment for value outperforming growth. Another thing that has been a key theme for us. Okay, S&P hit a 1-year high last month, but closed down more than 5% this month. 3 months later, you're up on average 6.8%. 6 months later, 15.5%. 9 months later, 22.1%. 1 year later, 25.49%. Dollar rolling over, more of that. Bloomberg dollar spot. Euro is climbing. 10-year government bond yield now close to, I think it got below 4 for a minute today. I'm not sure, but it's definitely at 4. And 5.1% 7-year ARM mortgages. Wait till the 30-year fixed hits a 5.9. I've been saying that. And if you don't have exposure to the home building sector, and I'm not talking about buying home builders because they're going to be as screwed as GM and Ford in terms of margins. I'm talking about the arms dealers, the building supply companies, the Generacs of the world, the Stanley Black & Deckers of the world, the QXOs of the world, Brad Jacobs Home Building Supply roll-ups with Beacon Roofing as the platform company. Okay, this is from when the NIBR recession announcement came as it relates to recessions, and then the total return after up 60. Okay, if you wait for the robins to sing, spring will be over. Recession start, recession end. Oh, okay, so the NIBR acknowledges recessions in the rearview mirror. By the time they acknowledge a recession, the market's already up on average 61% over the next 15 months. Okay, that's obvious. Here are the rate cut probabilities for June have now jumped back up to 84%. Tomorrow's jobs report is critical. We'll see if that comes in weak or unemployment ticks up, which wouldn't be really surprising. Given all the Doge and knock-on effects of that, then the Fed's back in play and the market starts to probably like the idea of the Fed being back in play, and maybe you find a short-term bottom here or a bounce. Corporate America's buyback stalls on tariff uncertainty and also excess CapEx spend, by the way, because Mag 7 was driving the buyback bus. Now they're spending it on unclear return on invested capital, which is why they're down, and is crowding out buybacks, another theme we've been talking about on this podcast. Challenger report announced job cuts. This is going through the roof, so let's see if it's reflected in tomorrow's report. Quarterly total returns, U.S. value stocks minus U.S. growth stocks at the highest levels we've seen since 2001, which kicked off what? A period of 7 years of outperformance of international versus U.S., a period of value over growth, and a period of small cap over large cap. So coming to a theater near you. Equity ETF still seeing almost $3 billion a day. Defense spending, U.S. has been able to spend less because of Trump's kind of twisting NATO's arm. Germany's going up. UK is going up to meet the requirements of NATO. Euphoria-o-meter that peaked. Car dealership guy. This is an interesting scoop. Ford is cutting pricing on most models. Unlike a few OEMs who are raising prices in light of impending tariffs, through June 2nd, car buyers can take advantage of special employee pricing on eligible Ford and Lincoln vehicles through the new, quote, From America, for America campaign. Dealer cash incentives are on the table for retailers as well. We'll be on the lookout. New pricing will be available on Ford dealers' websites first thing tomorrow. That came out yesterday. What does that mean? It means volumes follow incentives. As affordability goes up, volumes go up. As volumes go up, Cooper Standard's free cash flow goes through the roof. Were we buying Cooper Standard today? Yes, we were. 10-year yield. Okay, we can see this breaking down. It got even lower today. So the next level of support is going to be 393. It's going to blow people's mind when it has the 3 handle for a few days. It's coming. Value is still underweight despite the outperformance, which is the same thing that you saw in the early 2000s. Then they got overweight by the time it peaked in 2007. Value's dramatically underweight. This is what you see in the early stages of a regime change. China exports to consumption reorientation. So their exports have come down from 35% to 20%. Their consumption is starting to recover from 5% to now 39%, and their goal is to make it 70%. Alibaba, I think, gets 40 cents on every dollar spent on consumption. They get a toll through because of the amount of e-commerce that's done in China. So we are going to benefit from that trend. Chinese stock investors flock to Hong Kong to bargain hunt. Alibaba's Qwen 3, remember how amazing 2.5 was, better than ChatGPT, better than DeepSeek, etc. Well, now they're going to do even better. Qwen 3 AI model coming this month, sources say, in a bid to cement industry lead, ladies and gentlemen. Chinese stocks get a shot in the arm from stimulus moves, HSBC survey says. China's factory activity growth at 1-year high. Go where the stimulus is. You can only hold the beach ball underwater so much. Stimulus is now coming in Germany. Stimulus is in Europe. Stimulus is international. Austerity, US. It's necessary, but it's just what it is. And money will go where it's treated best. And right now it's treated best in China and in international and not in the US. Because why? Because Trump had to clean up a lot of messes from decades of neglect. And it's just, we got to take a little medicine here. And that's why the Mag 7's getting smoked. Part of the reason. Factory growth at 1-year high. Forget the Mag 7. Terrific 10 are the tech bet for 2025. That's Alibaba, Tencent, Meituan, Xiaomi, JD, NetEase, Baidu, BYD, Geely, SMIC. That's from not the lady who wrote 135 consecutive negative headlines on China when it was, quote, uninvestable, but they've apparently found a new journalist to cover China. Alibaba has staged a quiet $100 billion rally. AI and Jack Ma's return are at the heart of it. Wait until the Ant Financial IPO is announced. Alibaba price target raised to $170 at Mizuho. Top pick in Asia Internet, aka opinion follows trend. China stocks post modest losses as U.S. tariffs spur stimulus bets. China stocks power ahead of emerging market peers amid AI frenzy. Global stocks trounced in the U.S. during the first quarter. Is American exceptionalism in trouble? American equity outperformance is in trouble. American exceptionalism will never be in trouble. Why? Because we have the greatest from all over the world. We are a nation of immigrants. We are a nation of a melting pot of taking the best from every place around the world. We still have rule of law and free markets. And we're the innovators, and we have natural resources. So what else do you want to talk about? And we got oceans on both sides of our coasts, which is a good thing from a defensive standpoint. So yes, our equities can underperform because they pull forward a lot of gains, and they got too concentrated in a certain group of stocks that everyone crowded into, the quote most crowded trade. But they'll be fine. They'll absolutely do just fine, but international will do a lot better. Ford Motor Company will offer employee pricing to all U.S. shoppers. Handshake deal with every American. Maybe I'll have to go buy a Ford. U.S. auto sales up 8.8% in March as pre-tariff rush boosts new car sales. Why AutoZone and other car part stocks are gaining on Trump tariffs. Intel's new CEO vows to compete with NVIDIA's best AI server. There's a headline that wasn't on your bingo card on January 1st. Intel's new CEO is known to under-promise and over-deliver. Can we do it again? Look, we covered him a couple weeks ago. We're super excited about him being at the helm. And what he did at Cadence, just go look at the chart. Ticker CDNS. Boeing stock is a new top pick at JP Morgan. We agree. Exclusive buyout aerospace firms close in on $8 billion plus Boeing navigation unit. That'll help them to de-lever the balance sheet. Here's the manufacturing jobs. Is Trump's plans working? ADP shows biggest jump in U.S. manufacturing jobs since October 2022. U.S. 10-year yield drops below 4% for the first time since Trump won. Home sweet home stock market and sentiment results. So this is an update on QXO and the Beacon Roofing deal. Jeff did a good job going through the dynamics of the business. This is just a platform company, but showing how roofs are not a discretionary expense, and the age of the average home and the average commercial property in the US, there's huge amounts of pent-up demand for beacon roofing. And that's why when Brad Jacobs said on Odd Lots podcast that he's going to double EBITDA, he's going to double EBITDA. And then all the businesses he's going to be able to roll up, tuck in, and do like he did with XPO, with Waste Connections, and it goes through all the details of his past successes and how you have a chance to participate at the very beginning with QXO. We also wanted to talk about that theme as it relates to Generac and Stanley Black & Decker. What you can see is U.S. existing home sales and Generac holdings. So when this number's down, the stock goes down. When this number goes back up, the stock goes back up. And this is going to absolutely completely go off the charts. When you see a 5.9 handle with the amount of 80-something million 34, 35-year-old millennials starting families that want new houses, and Trump opening up 500 million acres of federal land, get your 1,500 square foot KB homes, starter home along with an endangered elk in your backyard free of charge. This is going to go through the roof. And when you live in the middle of nowhere, you're definitely going to want a generator because you don't want to be stuck with endangered polar bears next to your house without power when the power goes out. So it gets windy out in those 500 million square miles of rural Western United States. So that's what happens with Generac generators. That's what happens with Stanley Black & Decker, DeWalt, Stanley, Craftsman, all the tools used in construction. When you see existing home sales spike up, guess what happens to this and what causes that to spike up? Number one is demographics, which couldn't be better. Number two is affordability, which is a function of the cost of capital, which is happening right now. Telling you 5.9, it's going to be through the roof how many homes are going to be bought. And as that construction starts, you're going to start to see new orders come in like crazy. And that's going to happen very, very fast. And QXO is going to be a beneficiary. Here's another way of looking at it. 30-year fixed rate mortgage at 6.32. As it's written, what's collapsed? Stanley Black & Decker. As it falls, what happens? Stanley Black & Decker rallies as mortgage rates fall. Same thing will happen with Stanley. Same thing will happen with Generac. Same thing will happen with QXO. And by the time you figure it out, it's too late because they've already all doubled. So what were we buying Stanley Black & Decker today? You bet your ass we were buying Stanley Black & Decker like it was going out of style. Were we buying Generac today? You bet your bottom dollar we were buying Generac today. So that's how we do it. Moving along, U.S. 10-year Treasury yield rolling back over. That is what mortgage rates price off of, and that's what's going to get all these things. All you need to do is be burdened by the facts. By the way, for all you burdened by the facts, all 10 hats, my incredible new assistant, Jennifer, sent out all 10 hats this week. So you will be getting your hats. Please send photos with your hats to info@hedgefundtips.com, and we will feature you at the beginning of one future podcast, and that will be exciting. But sooner than later, you'll all be able to get any merch that you want, or not get any merch if you don't want. But I will be wearing my Hedge Fund Tips golf shirt and hoodie, because everyone in California wears a hoodie, because when you live by the beach, it gets windy. And that's how you learn how to become a good golfer, because you always got to play with wind. But that's for another podcast. This is Bessent's All In podcast. You should listen to that. He explains how he's going to continue to lower yields with regard to those bank charges that are going to be removed. And they haven't even done that yet. That's another 30 basis points. So it's coming, ladies and gentlemen. So, and then finally, congratulations to all the new clients that came in already. We announced our Q2 opening to new clients for smaller accounts. Recently, we'll be closing our Q2 opening for the smaller $1 million accounts on April 12th. To see if you qualify and to take advantage, you can click there, hedgefundtips.com. While you're at hedgefundtips.com and clicking on the money management to see if you qualify, also click on terms. This is all opinion, not advice. consult your financial advisor who has you in all those index funds and ask them whether or not it makes sense to buy Generac. This is the tech top 30 earnings revisions in the last 60 days have been revised down by 1.1% in the last 60 days. So prices obviously moved a lot more than earnings. Communication services revised down 19 basis points for this year, 99 basis points for next year. During sandbagger season, that's not bad. There are going to be opportunities there. We're paying attention. We're not rigid. We are, it's funny. We're as flexible as they come when the opportunity sets up. Just like we were buying Mag 7 in fall of 2022 and selling in July of 2024, we'll be buying again when the price is right and when it makes sense. That's the economic data. And then earnings have come down a little bit, 269.92. So they started at 275. They're down to 270. Markets moved more than that. So we're kind of okay. So podcast is over. Now we're going to do Ask Me Anything questions. I'm sure we got a lot of doozies this week from a lot of nervous Nellies out there. I'm not undermining that. I get it. People are nervous. But if you're not on leverage and you know what you're on, there's no reason to be nervous. You should be excited and taking advantage. So, okay, this is Johnny S. Am I missing something here? Retails are getting hammered today because of Vietnam tariffs, where a lot of clothes are made. As we saw with VF Corp, it's 15%. Move it to Bangladesh, call it a day. And you would think that if people are buying fewer clothes, they'd actually benefit from companies like Etsy and Depop, blah, blah, blah. Yeah, Etsy's fine. Etsy's fine. We bought some yesterday. Today it was actually, was it yesterday? I don't know. 2 days ago it was down to 46. Then it rallied to 49 on the tariffs. And today it was 40. It doesn't matter. Under $50, we're a buyer. They're buying in stock. They're generating a ton of cash. They'll continue to generate a ton of cash. No, you're not missing anything. Thanks for sending the question. Next one is from Kyle Kukta, Kuckta. Love your show and critically informative content you provide. I'm bullish on Stanley Black & Decker. Wondering the tariff implications on the share price, blah, blah, blah. Look, at the end of the day, they're getting tariffed. So is their competition. So they're the biggest game in town. They have the best tools. If you think someone's going to stand up a brand new tool company that's going to compete with DeWalt when generations of builders, their dad, their son, their uncle, their brother that have been building houses for 100 years use DeWalt and use Craftsman and use Stanley and use Black & Decker, you think they're going to come up with some generic shit that no one can trust to build these 3.8 new million houses next to the endangered species that Trump wants to open up the federal lands for? You're out of your mind. Stanley's going to crush it. Tariffs, no tariffs. If they'll raise the price of the hammer by 50 cents, call it, these builders are going to be making so much money. They're not even going to be able to carry all the money into the store to buy all the tools from building 3.8 million houses over the next 3 to 5 years. And building, and they still won't be able to sop up all the pent up demand for starter homes. These are not going to be 4,500 square foot homes and 6,000. You don't need an indoor pool as your first starter home. You just need a beautiful new house with all your Williams-Sonoma stuff and call it a day, okay? And the people building it are going to use these incredible tools, and they're going to stick a generator outside. So when your power goes out and you live in the middle of nowhere, you don't have to worry about bears climbing in through your chimney. Zek Hong, Mr. Hayes, I was just wondering if you were looking to pick up shares of VFC. Yes, we were doing that today. What were you doing? I hope you were not cowered underneath your desk. I hope you were able to take advantage. Could it go lower in the next 2 days? Sure. They make 15% of their stuff in Vietnam. God forbid they move a few products to Bangladesh or wherever else. They're going to figure it out. It's Bracken Darrell. This guy had a 28 bagger selling webcams, not curing cancer. He's going to fix it. I have absolutely no problem with Bracken Darrell. By the way, where did I put that? Oh, I want to cover, I didn't get a chance to do my favorite thing, which is zooming out and getting you guys to see that as noisy as this week has been, it's literally no big deal. Look, Here are some names that we've talked about on the podcast. Okay, so here's Advanced Auto Parts. Okay, it's going back, it's retesting, it's doing this bullshit. It's going to be fine. Shane O'Kelly's got it under control. It was lower last month. Now it's going to recover as this noise blows through. Albemarle. I love Albemarle. Were we buying some AAP and Albemarle today? You bet your bottom dollar. Albemarle is going to be a no-brainer. The global EV count is going up 100 million over the next 4-5 years. It's all going to be from China's subsidies. They're the largest player in town, $3.5 billion of liquidity. Lithium prices are cyclical. They're going to score. This is a monster. I mean, you look at this stuff day to day. Boeing, this is unbelievable opportunity to buy this given the situation. Who else is going to make the planes? It's a duopoly. Guys, step back and think. Baba, it's got to consolidate. The thing more than doubled in like 5 months. Let it just consolidate its gains, and then we'll take the next leg higher. Chillax. Baxter is going to be fine. They own the IV space. They own that little area. They got rid of the kidney business. You can't even see this move on the chart. It's been building a bottom for 2 years because that's how long it takes to build a bottom. It's no different than any other time. CCI has been up. It shot up from 90 to 170 the last couple of weeks. Why? Because of rates. So this thing's just getting started. They got rid of the CEO. They sold off the high capital intensive, low return fiber business. And now they've got the towers that just mint money. This is going to continue to go higher and going to continue to pay you a beautiful dividend while you wait. Cooper Standard, shockingly, hasn't even been affected by this. I mean, it's been stuck in this range for basically 2 years. And what we're seeing with the car volumes, the cash is going to spew out. It's going to surprise everyone. And this thing will be over 20 in no time. And then start to really work on some of the numbers we talked about with our beautiful interview with the CEO, Jeff Edwards, 2 weeks ago. Check that out at, go to YouTube, type in hedge fund tips, look for the interview with Jeff Edwards. Also known as episode 283 of Hedge Fund Tips with Tom Hayes. Comstock Resources taking a break. It's shot up from $8 to $20. So now it's going to rest for a little while before moving to over $50 and intrinsic value in Haynesville. Diageo is actually up today. Now that the tariffs are kind of like, we know what it is. It doesn't have to be good policy. It has to be known policy. And that uncertainty has been taken out. I like this. We bought a couple shares today. Disney, we didn't think we were going to have another chance to buy. Again, another stock, two years building a base. It will be back up. It will work its way to new highs over the next 3 years. We've covered all the reasons. Etsy was up in the last month. So I think there's, to your point on the thing, generating $500 million of free cash, buying back stock, getting growth in some of the newer platforms, figuring out the older platforms with rewards and some of the basic stuff. Generac, it does this every single time. You get the recovery, then you get the fake out and the retest, and you just climb the wall of worry higher and higher and higher. Why? Because they basically have a monopoly in the space. Then you've got GXO just doing this bottoming process. They will be fine. Hormel is rallying because why? People like spam more this month than they like last month? No, because everyone's nervous and they buy staples when they're nervous. This will be fine. Everyone loves spam. Planters peanuts, all the protein snacks that people need while they take their GLP-1s. Intel, we've gone through a million times. I mean, this, you can't even see what's happened. Literally, you cannot see what's happened in the last 2 months on these charts. And everyone is like, the world is ending. No, it's putting in its bottom. That's what they do. That's why they call me Turnaround Tom. It's because I have ice in my veins when these things are happening. While everyone else is panicking, we're just chill as a cucumber. And that's why people give me their money to manage, because they don't want to have ice in their veins. They want to run their own businesses. They want to get on their private plane and go to the beach and go ski in the Alps and go to Mexico and do all the fun things they do and pay me to worry about it. And that's what I love to do. I love pressure. I can't live without pressure. It makes me so happy. That's probably why I took up golf. All right. Intel, that we covered that. PayPal. Okay. Cash machine. Okay. So the EU threatening tariffs, all that stuff. Look, they could tariff them 100%. PayPal is generating so much cash. They're going to be fine with or without the EU. And chances are it will be much better than advertised. Stanley Black & Decker. Okay, you could actually see this one on the chart. It's corrected a little bit in the last couple of months, but it's no different than what you saw in when? 2001. It scares everyone out of the stock before it goes back and retests new highs. New highs in this case would be $195, $198. The stock is $64. These are the normal bottoming fake outs when everyone's scared. And here we are. We're probably right around here. Maybe we shoot all the way down to 60 or 50, which would be absolutely incredible. That would make my day. And then boom, straight up to 190. But my guess is we're probably there at the moment. But this is how bottoms are made. You always should take out the lows, get every last weak sister out, and then you just take up to new highs. When you have a business that has a moat, we're not talking about some garbage business, Chinese micro cap that has good looking numbers on paper and 3 years from now winds up being a fraud. Here, VF Corp. Well, does this look a lot like when? 2001. Completely collapsed, okay? Then took a little while to put in a bottom, rallied like crazy, got everyone excited, just like we shot up to 25. You couldn't give it away at 15. Everyone wanted it at 25 and was super excited. And then what? They pull the rug out and they go back and test the lows before they go all the way back up to 2x their recent highs, which would be $160. I'm not saying we're going to $160. I'm saying chillax. Bracken's got the wheel, man. You hire the right managers, he's going to figure it out. He's a winner, okay? Nothing to worry about there. XBI, this thing is doing what we see every single time. You bottom, you retest, then you start to go up, scare everyone one last time, and then you go straight up parabolic and leave everyone in the dust, just like we saw with Baba. Same thing's coming to a theater near you. It just happens to be called XBI Biotech. Next question. Is that Jason? Yeah, okay. So how do I delete this? There we go. Next, Clint Murray. WSM, Williams Sonoma, put it on my radar. Yeah, look, that's another housing play. So let's take a look at what's happening with the fundamentals on Williams Sonoma from Clint Murray. Yeah, I don't know if this has come down enough, ladies and gentlemen. Let's take a look at the financials. I think you might be a little early on this one, buddy. Willing to be wrong on that, but for me, I'd probably pass through. Let's take a look at the financials. WSM. All right, so cash flow is actually rolling over. Is this? Yeah, I don't like that. And price is starting to follow that. I don't like the trend. Their margins seem better. Revenues are still weak. Look, could it recover? I would just rather see a greater margin of safety. I'd like it to come down a lot more than that, or start to see the cash flow go up before I get interested. Because even if the cash flow goes up, the price should lag it for a while, just like it lagged it on the way down. Cash flow was falling, price kept going up. Cash flow will start to go up, price will keep going down, and then I'd be more interested in that. So for that reason, I understand what you're saying. It should benefit from the housing theme, but not ready. Linda Williams was wondering if you thought Restoration Hardware. Same theme. I think too early for me and too rich for me. They got a restaurant here in Newport Beach down the road. That looks awesome. I'm going to go there. You might be getting close, but starter homes is going to be the name of the game here, and Restoration Hardware caters to older people with money, and those people are downsizing, not upsizing. I never liked this name at all. As a matter of fact, the first day I was on Fox Business, late 2019, it had been on this parabolic run right here, and they wanted to talk to me about it. And it's the last stock I wanted to own. It was trading at I don't know what it was, 150 times earnings and 50 times sales or some ridiculous thing. And it was literally right here. And I'm like, yeah, this is not for me. And, little did I know 2 months later would be COVID, and the thing, collapsed 66%. But back here, when they had me on, everyone wanted it, which is why they wanted me to talk about it. And it was really hard because I didn't want to poo-poo it because everyone was so excited about it. And it was my first time on TV. So that's that. Long story short, it went well enough. They invited me back on, and that's that. And their cash flow is negative. So hard pass until I start to see positive free cash flow recovery. Next one comes from Thomas Barr. If DSWL were a US stock, would you buy it? I don't know what that has to do with it, but considering my biggest position in my portfolio is international. But DSWL. Overview. Based in Macau. So this is like a Chinese company? No. If it were a US company, would I buy it? No, I mean, they have no revenue growth. Let's see cash flow. This is even too tiny for me in the US, probably. What's the balance sheet look like? All right, clean balance sheet. Just, what's the turnaround plan? How are they going to reaccelerate revenues? I mean, this thing's had a huge move. It's up 4x off the 2016 lows. So what's the growth story moving forward? I think there are higher and better uses of your capital, but thanks for sending it in. Jason Zen, normally don't dabble in rumors, but this one's too good to pass. On the heels of the BMW Alibaba AI partnership last week for the Chinese auto market, rumors are now circulating that Tesla is planning to partner with Alibaba to leverage their cloud data center assets for full self-driving training. This makes Baba a player on both AI fronts, the generative AI front with their LLMs for BMW and the physical AI front in hosting GPU clusters. Cheers, Jason. So what's your question, Jason? His question is, can I get a pat on the back for buying it in the hole when you were backing up the truck at 60? And the answer is, of course, you can get a pat on the back, Jason. I know you've been buying in the hole hand over fist, and you are smiling so wide you could eat a banana sideways. Well, that's what you get for supporting Hedge Fund Tips with Tom Hayes. We're very grateful for your support. Monique Bojwani, enjoyed your response to gold question on CGTN interview. Thank you very much. Thank you for tuning in, and thank you for all your support. Lou Dumont, thanks for your great teachings. What is your view on ACIC? American Coastal Insurance Corporation. No. Look, insurance is cyclical. I know all the insurance brokers on the phone are going to tell me this time's different. Prices are going to stay high forever. But I remember being an analyst in 2009, and I'd go to all the meetings at the New York Society of Securities Analysts, and they'd have all these insurance companies that were just completely decimated. And I was a value guy, so I wanted them to work. And every year they would come and they'd say the same thing. We're so excited. Prices are going to start hardening. It took 10 years. So prices have been hard for 5 years. All these insurance guys are making fortunes selling their little brokerages, $2-3 million brokerages to private equity for $30 million and getting rich, and $100 million and getting rich. And the smart ones are hitting the window because the window won't last, and they're going to get very rich. And hopefully they're going to be smart to give some of their money to a manager like me to help them out. But price hardening is not going to last forever, and I wouldn't want to be in this space, particularly with this company that's already recovered off its lows. So I'm going to pass on that. Rachel D. Hey, Tom, why don't you like Crocs? Their buyback plan seems like a smart capital allocation. Are you seeing something different? I'm seeing that shoe companies run in phases, and I want to buy the ones that are in the hole right now, like Nike and like Vans, VF Corp, over Crocs, which is just coming off its heated run. Cash flow is good. Revenues seem to be slowing down. I think they gotta relax. Everyone that wants Crocs already has them. I mean, my kids have them, but there are only so many swimmers and chefs in the world. At the end of the day, you run out of chefs and you run out of swimmers. And until they come out with something new, or the kids get tired of wearing stuff, I think it's going to breathe. I would rather buy the ones that you can't give away, and Crocs is not there. Crocs has had a great run, and they're probably due for a pause, in my opinion. Revenues seem to be flatlining, which is supportive with that. Their gross margins have been down since 2022, starting to recover. You might be right. I'm not going to knock it, but it's just, for me, it's not. I look for the fat pitches that I don't even have to think about. And that one's like, yeah, maybe you make 30, 40%. I don't know. Good luck. I think possibly that will happen, but it's got to be at least a double for me, or I don't look at it, and I don't see it in Crocs. Tom, thank you for all the work that you put into the podcast. It's truly amazing, educational for a student like myself. Question has to do with outperformance of European stocks versus the U.S. Stimulus, consumption, short euro dollar. It's all of that. It's all the above. It's the stimulus. It's the weak dollar, strong foreign currencies. That trend is just beginning. You're on your way. So long question, but your premise is correct. Christian Dye, thank you for all the work. To my young looking circle, please look at Brembo, leader in premium braking system segment in Italy. BRE. Maybe. But you're going to really have to know it. You got to know who their customers are. You got to know what their edge is. You got to know it as well, if not better, than I know Cooper Standard. And that's going to take many, many months. Free cash flow deteriorating last year. Balance sheet. Let's see. Balance sheet looks okay. Looks like they did an acquisition or something there. What about the share count? Pretty decent. It's definitely worth doing the work on. I'll leave it at that. You really have to understand their customers and how well they're going to be doing. If they're supplying exclusively to European automakers, I wouldn't be interested in it, because the Europeans are letting the Chinese flood their markets, and good luck with that. Henry Griffin, how much Excel do you use in your analysis? Excel is the language of finance. So you got to learn that stuff. You got to take your CFA. If you're new and have no experience, that's a way to get good experience pretty quickly. Jimmy Jones. If your idea that the Mar-a-Lago Accord could recreate another 80s bull market in China, as you stated in your last podcast, does that change your intrinsic value in that environment? Would you hold a position longer because of that situation? No, I know where I'm getting out before I get in. If it gets so much better than I could have anticipated, maybe I'll hold a piece longer than I would have, but I know my game. I just I take the middle out of the sandwich. I don't need the crust. David Mulinex, what do you think of Rentokill RTO? So it's down like 40%. What do they do? Pest control services. Kind of like that. But they've had a monster run. So you really run the risk here of this being a broken growth stock. And if that's the case, these things take an awful long time to rebuild. So if it doesn't hold here, you're screwed, is really what it comes down to. And if it does hold here, you probably get a quick 60, 70%. Again, it doesn't meet my double criterion, and especially with the cash flow starting to deteriorate after it's had such a huge move, that's a pretty big warning sign to me. The cash flow is basically back at 4 year ago levels, and the stock is up 12x. Not enough margin of safety. You might be right, but that would be a pass, easy pass for me. Question from this guy, Warren, asking about Diageo. We bought a few shares today. I'll leave it at that. Diageo was actually up today, which was kind of interesting. So with that said, we'll be back next week. Same time, same place. Well, first off, thank you. Thanks everyone for tuning in. We'll be back next week. Same time, same place. In the meantime, make it a great one. Bye for now.